I? Yes, I am. Okay. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may vary from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Fantastic. All right, let's see what happens next. We'll take a look at our system and see how things are looking. We had a, wow, guess what people want? Damn it. I got out because we had this huge profit. See, this is the old contract, N5, and that one was up $5,800, and the Q5 contract was up $6,400, and that's what I don't know. It's a lot of money. It's like $12,000. So that seems like a lot of money to make in a day. So I quit. I quit down here though. So when it started running out of gas over here, I figured, this is probably not going to go higher. You know, I said in chat at the time. Where is chat? It's last week. I just said this in chat, but I thought I was going to blow my opportunity. But I just can't. You can't, you know, at a certain point, you've got to be satisfied with your gains. But you never are. I mean, the reality is, you know, if it goes up further, you go, oh, I can't believe I sold it. And it's like, oh, I can't believe it. In this case, it's like, literally, I'm saying, oh, I can't believe I only made $12,000. But I was saying it right around here, wherever.
Order pending.
Uh-oh, I didn't mute people. That's not good. Here, I was going through my angst over this thing, because I said they took my RBs off the table at 203.5, because RBs were up over 12K, and you just can't leave that on, especially when I have to, you know, I got things to do, so I'm kind of like, can't sit there and stare at the thing. It's just crazy when you get a move like this in a single day. You know, and this is today basically. When you get a move like this in a day, like what we did is we came in, we held it over here, we continued to hold it here. This could have gone the other way just as easily. It could have collapsed. I mean, obviously we were betting a lot of money it wasn't going to collapse, but it could have collapsed. But instead, we got exactly what we thought we would. It sold off down to here, and now it's taking off back to where we expected it to be at 210. Although way earlier than we thought, because we thought it wouldn't happen until the holidays. Let's see if anybody has any questions regarding the gas situation. Jeff says I'm greedy. Uh-oh, sorry, I forgot to mute people. Hang on. Mute line, right? Is that what I'm doing?
You are now muted.
There, that seems better. Okay. Just reload this page if you have audio. Okay. All right, anyway. So that's the gasoline situation. I was hoping for a pullback. I was hoping we'd come back to 202 and I could get started again. It just, at a certain point, you got to say, look, I got enough money, I'm going to stop. You can't just ride everything out forever. You never know when it's going to turn. This was a logical, I stand behind my decision. This is a logical place to take it off the table. Here, it hit 305, and it hit 307, actually. Pull back a little bit, and this isn't enough of a pullback to get back in. It's nothing. So probably we're going to go all the way up to here. This second support line here, 206, will probably hit that, and that'll be like 210 on the old contracts, and then we'll do it. These contracts aren't done yet. That's why we're having such crazy movements. RBN5 still has until Thursday, I think, to trade. So we're going to still have some wild gyrations, and hopefully we'll get another nice sell-off to do another entry. But now you know why I have such incredible conviction on trading these gasoline contracts, because they're a freaking gold mine. I mean, when you hit them right, they're fantastic. All right, but still keep in mind, this thing went all the way down to the old contracts went all the way to the $2 line. The new contract's at 197.13. It's very, very painful when you're wrong. It's just about as painful when you're wrong as when you're right. So that's why we don't play gasoline very often, because it's just a very expensive contract. You don't have a lot of chance to adjust your position. And look at this spike. I mean, this spike from 199. It's not even 199. It's 198.5 to 202. These are 5-minute bars. That's in 10 minutes, or let's say 15 minutes. You're looking at a $1,500 move or a $1,200 move. That's a lot of money. That's per contract. All right, so it's not for everybody. It's a dangerous kind of trading. It's very can really hurt you. It's very exciting to see like really big gains, but on the other hand, it can really burn you the other way. All right, on the broader market, let's see. We got everybody's kind of flat now. We got the Dow, the S&P. The S&P once again busted at 2020. Can't get over it. This goes back to the same thing. This was, yesterday was a very bullshit. Let's get back to the chart. As we pointed out during the session yesterday, and as I got Dave Fry's chart this morning, here it is. All right, the S&P. First of all, it didn't go up during the day at all. The S&P opened up here. All right. It opened where it closed, at about half a point. It went up a little bit here in the morning, but see how the volume declines? The S&P is jammed up on zero volume in the futures. All of the gains for the day came before the thing opened. Then the rest of the day, it jacked up because this is what retail people do. Retail people go, oh my God, Greece is fixing the S&P is gapped up and blah, 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 and I'm going to buy. And they're buying, but meanwhile, they're being sold into. You can see on these charts, I don't know how, I hope it's clear enough to you guys. Well, actually, if I open this in a new tab, I bet I get a bigger picture. A little bit bigger. All right. So you open that new tab. So these are not strong bars. So you got a big red bar right away, people selling into suckers. Here's some buying, then another red bar, then red. This one's not red. Red. Then another up one, then red. So people are constantly selling into the things that are being bought. Here's red. It's all red from 11 o'clock until 12:30 is nothing but red. There's more selling. In other words, there's more selling going on than buying. And overall, the volume is pathetic. 67 million is half a day's volume. That is nothing. This was a meaningless move. That's why this morning we were very happy to short when we got up, because we had another little stupid move up in the futures this morning. And let's take a look at the futures charts. Yes, here they are. Hopefully. There we go. And we'll find the Russell. So what did we see this morning? So this morning when we came in, which was over here, where did I start? That would be a B. See, in our live chat room, until I write a new post, which is usually about 7:30, about 8, a new post is usually published. Until then, the chat we use is still the previous day's chat. So at the end of Monday's chat is where you'll find very early morning commentary. And it was, here you go, 3 a.m. This is me at 3:02 a.m. All right. So we're just talking about blah, blah, blah in Europe and what's going on, the Asian stocks and what we see, and the home building stuff and the housing. And then I said at that time, 302, 1290 is a fund short on TF with tight stops above. So then we go take a look at what TF actually did. And this is 1290, don't forget, okay? So that was me at 3 o'clock in the morning, right about here. All right, and we're looking for a break below. Here's 3, right about there. So we're looking for a break below 1290. Now, mechanically, it's very important to understand what happens here. Russell was, when I made the comment, the Russell was kind of breaking down or right about on that line. What happens is, though, because we start selling, we go short, the bots try to throw us out of our position. This is why we always want to scale into positions. The act of us, it's like a Schrodinger's cat. You know, the act of us observing or interacting with the Russell caused the Russell to move against our position. There's a couple of factors here. There's a factor of people who are following the trade are anxious and overpay. They don't wait for 1290 to cross. They jump in right away at higher prices. So then they start because they're bidding up and they're selling at higher prices. They're driving up the prices. They're willing to overpay for the short. And so by chasing the short, they cause the stock to go up. That's part of the reason it goes up. Then sometimes those same people have a very low tolerance and they'll stop out of the short. That's another bad habit. So as soon as they enter it, they go, oh, I got to stop out. It went up the wrong way, and they panic out. If you scale in, which of course is what I always do, is you're going to sell a short here. And I said tight stops above, but tight stops doesn't mean like one tick above. It depends on how you're doing it. But in this particular case, you're going to play, you could play with tight stops, and you would fail here, right? This is across below 1290. Fail here, small success here. But if you're going to take a small failure, you should be taking a small success too. But a small success here, then spike out above. But then this time, it's successful. But you see how easy it is? So you get a fail, small fail, small fail if you're using tight stops. Even call this one a small fail. That's 3 small fails, and let's say your stop tolerance was a quarter point. So you lose 0.75 here on 3 shots, but then this one gives you drops you all the way down to 87.50 for 2.5 points before you would have your stop line here, of course, before your stop line is breached. There's no breach, there's no retrace here that breaches a stop line until you get down to here. Then you if you keep following down with a half-point trailing stop, the only time that actually triggers is here, when you cross back over here. So so when I say tight stops, this is up to you. I mean, you can call it tight stop, whatever you call a tight stop. You've got to keep it proportional, though. All right, you can't have if you're going to have 1-point stops, then you're looking for a 5-point profit generally, right? You better expect that. Obviously, 5 points don't happen very often, though, so you're better off with half-point stops or quarter-point stops, and that way a 1-point move in your direction is going to make you money. Now, in this case, though, scaling is different, though. Scaling is I would go short one on 1290, and then at 1292, I would go short another one. But I'm not stopping out because I'm going to average 1291. Then at 1292.50 or maybe 1293, I'll do another one to average 1292. Then I might stop out. Now, my system, I'm going to take a loss of a point or a point and a half when I finally do stop out, when it seriously moves against me. Now, what's seriously moving against me? 2.5 points is a serious move on the Russell. So 2.5 points would be a big move against me. That's $250 per contract that I'd be losing, though, on the first contract. But my win, in that case, since I'm scaling in, if I do happen to hit it right, and since my average entry is 292, when we finally get the drop, I got 3 contracts going down instead of 1. So it's all the same thing. It's the idea is to keep your risk lower than your reward. All right, you always have to have a clear path where you say, well, gee, all it has to do, and as a rule of thumb, if you want to make a rule of thumb of it, I'd say, as a rule of thumb, you want to make sure that a 50% move back, a move against you, right? So here's a move against you of 100%. And that is a great illustration, right? If you're determined to stick with this, at any given time, you need to say that a 50% move back is going to get you even. If a 50% move back can't get you even, you shouldn't be playing. Then you're on a bad path. But here you go. So if you're looking for 50%, those happen all the time. So here's a move, 50% retrace. So if you double down here, you get out even. Now you have 1 again. Now it goes against you here. You double down, you get out even. Now you stick with it, and you go down here, and here you might double. Maybe you triple down here, and now, boom, you're out again. All right? You don't really get a, that's being relentlessly short. But I'm saying if you pick a good top, and you start off that way, and then you start doubling down, then you can get rewarded with a nice move. All right, now let's see if anybody's not clear on that or has questions. Let's see. Okay, Chrissy says, yes, the dollar was going down, the Nikkei was moving higher. Today it's up and the Nikkei is higher. That doesn't make any sense. Okay, well, yesterday, wait. The dollar goes down and the Nikkei was higher. Yeah, well, Nikkei was higher because Greece was fixed. All the markets were moving higher and the Nikkei moved with it. With Nikkei. Whatever that is, I'm sure I don't want to see it. All right. Here's today, here's yesterday. Okay. So, and also, by the way, the Nikkei wasn't really higher. Let's look at an hourly chart here. This yesterday here is before our market opened, okay? So most of the move in the Nikkei up yesterday was pre-market, and that was Japan actually having a good day. It didn't matter what the dollar did. As our dollar put a kind of lid on it, 20,600, but then when the dollar fell tonight, that's what, see, here's your new catalyst. The dollar fell, the dollar tonight rose, and the Nikkei rose with it. Now we're at 29.20. It's not all about the dollar. The Nikkei has other, the Nikkei has other reasons to move than the dollar, but the dollar is a major factor in pricing the Nikkei. It's not the only factor. And in yesterday's case, Greece was fixed. Kuroda made some indication there would be more QE and so on and so forth. So there were several reasons the Nikkei went higher. And now it's at 29, and I don't know, I would say it's probably more dollar dependent now just because there's no other particular catalyst. All right, and the dollar at the moment is where? The dollar's pretty strong now. It's over 95.50. All right, so it's you can't use that as the only reason you think the Nikkei is going to do anything. That's not how it works. All right, if you want to look at gold, you got a better chance watching gold for that reason than you do for the Nikkei. Chow says, do you see another entry developing? Was it a holiday weekend? No, I see an entry because don't forget the gasoline contracts expire this week on Thursday. So hopefully there'll be a bit of a sell-off between now and Thursday on those N5 contracts, and that'll drag Q down with it, and then we can get into the Q contracts again for a better price. Or I may have blown it, frankly, from that. I mean, look, I don't know if I say it's hard to say blow it. I'm ashamed to have only made them. The shame of making $6,000. Look, we got a perfect entry. We caught a fantastic run. That's all there is to it. All right? I don't expect, when you make 6 cents in a day, I don't expect to make 6 cents again tomorrow. So, therefore, I've got more risk tomorrow than I have by getting the cash now. And you could lose the whole 6 cents overnight. So why do I want to sit on that for? All right? I wish I did. I wish this thing had not gone up so fast. If it had only been at 602 now, 202. If it had only been at 202 or even 203, I probably would have stuck with those. But I couldn't turn it down. It was too much money. All right, so that's the end of the trade. The opportunity has passed in that particular case. But there's nothing wrong with that. Okay, it's like you don't have to play every trade for every penny. There'll be another obvious trade that we'll see developing. That's a big mistake futures players make. They fixate on a certain contract or they fixate on one thing. It's a situational thing. If you want to learn, you watch different markets and you say, oh, this contract is now acting irrationally. Therefore, there's probably an opportunity for me to make some money. And you know what I watch? I watch the indexes. I watch the Nikkei. I watch gold. I watch silver. I watch copper. I watch natural gas. And we never play copper, right? Because it's just never at a good spot. I watch natural gas, which is another one we hardly ever play. We don't play silver very much, but I watch it. I don't play gasoline very much, frankly, because I don't like how volatile it is. It's a pain in the ass. But there are certain times when you can say something's kind of obvious, like heading into a holiday weekend, it goes up. That's certainly an obvious thing. Uh-oh, look, see what happens? See, somebody asked a Q&A question. Now, it's way over here. Don't ask Q&A questions. Ask them in the chat box. Surnda says, is oil a good short from here? No. No. July 4th weekend, dude. It's the biggest demand weekend of the year. All the planes, all the flying, all the driving, forget it. It's the absolute worst time of year right now to short oil. After July 4th, we are probably going to want to short oil. The higher it goes, the more we're going to want to short it. Sean says, spotty audio like there is a connection issue. Okay, well, I guess it means you can hear me, Sean. I'm sorry, but that's something definitely you want to let Greg know. Or Greg will know because he's obviously going to find out. But I imagine it probably is a connection issue, but I think honestly, I haven't seen too many problems with people, but maybe it catches up. Maybe it's like a buffery thing. I don't know. All right, but we don't have any control on. We can't control that here, unfortunately. And like I said, rebooting maybe is an answer. Maybe check your own connections. Maybe you have too much stuff running on your machine. A couple of things like that you might want to look at. Chrissy says, do you want to short Nikkei and the dollar is rising? Again, I got to short Nikkei. The dollar rising is a factor in shorting the Nikkei. It is not the only factor. I don't see the dollar rising and immediately short the Nikkei. I short the Nikkei because it's at 20,100 or 20,900, and I really, 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 really don't believe that 21,000 is going to hold. Oh, why does it still say Q&A 1? Huh, close this window. All right, guess that's going to be stuck there now. So based on several things, yes, and in fact, it doesn't deter me from shorting the Nikkei right now because I still think the Nikkei is too high. But when I see the dollar rising and the Nikkei rises with it, I say, oh, that's not a good reason for the Nikkei to rise. Therefore, my short, which is based on the fundamentals going on in Japan, takes precedence. But again, the Nikkei is another dangerous instrument. You can get very burned on it. I mean, they can announce some more stimulus and the thing could pop up tomorrow. All right. Lucas says, audio. There's audio options in the checkbox above the chat window. I didn't know that. Oh, thanks, Lucas. Good to know. Do you have conviction on NKU? I don't know what is that? The Nikkei contract? Is that the current contract? Is NKU? There's no thing called NKU, is there? Oh, okay. But yes, it's NKD. We have conviction on. Holy crap! Oh, I got to stop looking at gasoline because I'm getting depressed. It's just, oh man, I mean that's a lot of money. That's a nice little bonus, couple of $1,000 a contract that I left on the table, unfortunately. Oh well. See, that's when you start going, I really wish I had taken that. But now the question is, what's going to be the next one? Well, the next one, if you look at the Russell's coming back to our 1290, and I made about, what was that, 480 this morning when we were shorting the Russell over here off 1290. And that was this little drop over here. It was like, it's just almost $500 got off that one. Could have gone again here, but I wasn't paying attention. Could have gone again here. Here's the funny thing. Look at these drops. $500, $500, $500. Very reliable, right? So we'll keep playing 1290 short until it breaks. But we'll see what happens. So let's get away from RB because I can't stand it anymore. How about, we can take a look at Dow, YM. And we'll take a look at gold. Oh, gold should be fun. Now, gold's down for bad reasons. Actually, let's take a look at the dollar. So there was another reason, by the way, where I wanted to stick with the RB because what's wrong with this? So the dollar DX and gasoline, not N5. Let's go for the RB Q5. That's the current contract. Okay, so what we had here, same time frame, is the dollar was rising from 94 to 95.5. So that's about 1.5%, right? At the same time, gasoline was falling from 203 to 197. That is also 1.5%. So you see, that's a really good correlation. There's nothing going on because now that doesn't mean it's the only factor in the world, but there wasn't anything else really going on between, with gasoline. I mean, there's nothing going on with OPEC. There was no demand stories. There was no issues. There's no inventory. So in that case, gasoline was on its own volition, just drifting along around the 202 line. But then the dollar pushed it down to 190, whatever the heck, 196, 197, whatever. All right? And it's really almost entirely due to the dollar getting stronger. So if gasoline is going down, not because of anything that happened to demand, supply, fundamentals, or anything like that, but it went down mostly attributable to the dollar, then I could say to myself, well, gee, even if the dollar goes up further and gasoline goes down lower, it still has nothing to do with people buying gasoline. And that means it could snap back very easily. And look at the snapback. So, probably gasoline would have been going up a bit had it not been depressed by the dollar. And so it's really coming back hard and fast now. That not that the dollar has to go down, it only has to stop going up. It's the up that puts pressure on gasoline. Once it gets to this spot and stays there, then the dollar is steady, and now you have to look at the fundamentals of gasoline and say, hey, people are buying gasoline into the holidays, and there it goes, up. All right, that's how you use fundamentals to play with conviction. And that's how come we can get into like a bigger and bigger position on the way down. And I said that yesterday. I said, look, when it goes lower, buy more. When it goes to here, buy more. We planned on this. This was our trading plan, was to buy more, to buy at 202, buy at 2, and buy at 198 so we could average out about $2. And that way when we get a nice pop, we make $6,400. On what? I ended up with 5 contracts and made $6,400. It's very nice. And that's it. Not only is that from yesterday, it has been yesterday because we already cashed out yesterday. We did this one and cashed out. So this move we already made our money on. I'm talking about this move from $2 back to 198. That's when I added the 5 contracts. I had a couple into here, and it went over here, and then they went against me. Don't forget we're bullish. So somewhere around here, we went back in as a bullish trade after cashing out. Oh, I know what happened. I'm sorry. I'm saying it wrong. We doubled down here or whatever. We took the money and ran here at 20 whatever, just almost 201. Then it went down further. Then we added more. Then it went up, but we didn't do anything here because we were hoping it would go higher. Then it broke down and we added more. So we already cashed out. This one was out. This was our success. Even though it doesn't look successful, it was successful for us because we kept at it. But then this one, same story, really. It went down completely against us, but now when it popped up, we made a fortune. All right, so we take the money and run. And what I hope happens now is I hope it pulls back. I hope it pulls back all the way back to $2. So I freaking love that. Because at $2, I have massive conviction. At 2, I would only take 1 contract long. But I would take 1 long at 2. I would take another 1 long at 2. 1 long at 202. I would take another 1 long at 2. That would give me 2 at 202 at 201 average. Then at 199, I would take 2 more. That would average me into 4 at $2. All right? Then at 196 would be the next place I would want to buy more. So I might go up to 8 at 196, and I would average 198 on 8. I'd have 8 total contracts at 198, but I would be down 16 times 4. I'd be down about $4,000, $5,000 if I did that. If it was down at 196, so then I'd have some real conviction. So along the way, as it happens, obviously I don't have to automatically just add in. Every time I check, I read the news, I look at my sources, I figure out what's happening, I check message boards, I do everything I can to verify that my premise is still valid. Before I pull the trigger and buy more stuff, I got to make sure that I'm still in for the right reason. And then I'll sit there and double down. Then I'll scale into the position. All right? And again, this strategy only works if you can lose that $5,000 and it doesn't change your life one bit. This is not about your rent money. This should be about, literally, here's $6,000, right? So I'm going to Disney in a couple of weeks. all this means is that we're gonna probably take a boat ride somewhere or something like that. You know, it's like the only change in my plan of any kind that $6,000 is doing for me is saying, oh, you know what, my family's gonna be up on the weekend, we'll rent a boat. You know, now I'll blow $2,000 on a boat because I just made $6,000. If not, I just wouldn't rent the boat. That's the difference in my life, though. That's how you have to think about it. If you can't afford this kind of stuff, I mean really afford it, not afford it like, oh, well, maybe I can, you know, maybe I'll be able to make the rent next month. That's not the same thing. So, you know, you should only play these things in proportion to what you can afford to lose. And if you can't afford to lose it, don't do it. And I know it looks like there's really sexy gains to be made and stuff, but there are ways to do this much more conservatively with less contracts. You don't just scale into something. My way is an aggressive way for high net worth people to trade. It's not for everybody, okay? I want to keep that in mind. It's a very important concept. All right, let's see. Savvy. What can you do, Savvy, huh? Hey, he's coming back a little bit, right? 205. You never know. And anyway, so Savvy's one of the top gasoline traders, so she's in this thing usually. So, but on the other hand, honestly, every Thursday we get an opportunity practically to play. Every Wednesday or Thursday. Sometime around Wednesday or Thursday, gasoline will usually make a low, like it'll dip down, and then sometime between Thursday and Friday, it shoots back up to make a higher price for the weekend, so that everybody can get screwed at the pump. That's one of the most reliable trades on the market. Is doing that. I really like that one. Let's see what else we can do. I know what I want to do. I want to go over the portfolio positions. So let's see how we're doing. We got, this has to be rebooted. What's going on here? There we go. All right, short-term portfolio is getting damaged. It's down to 123%. Pretty sure I got everything updated properly. Yeah, there's no Junes left, so yeah. No. Short call, June fast. See, I left one. I knew I didn't get them all. All right. So fast is a 34, blah, blah, blah. Well, this will have to be fixed and whatever. But other than that, it's pretty reliable. Look at it. I don't honestly remember what we were supposed to do with fast last time we did a review. I guess I could check. Go to our portfolio reviews. If you remember, let's see. June portfolio review. And what did we say we were going to do with that FAS? I hope I said something. So we were at 130. This was on the 13th. So it's 2 weeks ago about. No. Yeah, it was almost 2 weeks. FAS. Oh, come on. F. We'll have to worry about if 25 turns up as support. I'm pretty sure I like the short calls as a new trade. Well, that wasn't helpful at all. So I didn't have a plan there. Hopefully I had a plan on Friday then. What did we do? All right, well, I'm not sure what happened. We certainly should have had a plan to do something with that. I don't know if I missed it or not. I'll figure it out. Anyway, so these calls expired in the money on Friday. I don't know where FAS was at the time. So I go to Yahoo. I can figure that out. Here's Yahoo. So that's not so bad. 33.50. Oh, that's a lot better than today. All right, so Friday those expired at 33.50, which means we sold the 30.25 calls. So at 33.50, these were 325, not 430. So it's actually better than it looks. These are 325, and that's a lot of them. That's 48. And then hopefully, and even if we didn't, obviously we want to roll these to July. We're still pretty bearish on fast, but let's see what we're at. We're out, I'm sorry, what do we, my brain. 33.50. And we sold these at 30.25. All right, so that's 325 is what we paid back on Friday. We sold them for 274. That's not even a loss. All right, but we are still kind of trying to recoup. This is a loss that we kind of rolled forward a few times. So we are trying to recoup, but on the whole, we've got 100 long positions in FAS, so we're doing well. We have the January 29.50 calls. We have the, and those are nicely in the money. So in fact, we got them to 650 there, 670 there, 715. We have the 1750 puts that are short. Those are doing fine. And then we have the 35 42.50 bull call spread for 2017. So on the whole, we're bullish on fast. We're looking for it to go up, and it did go up, but it just we got caught a little bit shorter than we wanted to be. So now, before we even decide that, we should take a look at the chart and see what fast is doing, and think about we're coming into earnings, always a big deal. And fast, of course, is a 3 times ultra to the XLF. So we're just up and up and up and up coming into earnings. We're at the 35 line here, and XLF is probably the 25 line, if I remember correctly. Yeah, and XLF is right at 25, but it did pop over it, and also up and up and up and up. Okay, so they're both like zooming along. You know, I think this 50 is going to hold. I don't think anything that bad in financials is going to come out this week, in the next month, that's going to break this 200-day moving average of 24. So therefore, it would be silly for us to sell any calls that was too deep in the money. But on the other hand, I'm probably not going to be happy with the premiums. Now we got to see what we can sell. And if I already did, I may have already gone through all this and made a call, but I just don't have it written down, so I don't know what the call was. So for our fast, which is currently at 34.35, if we sell the July 34 calls, those are $1.32, but that gives us very little premium. It's well, it's almost $1. It's not terrible. But earnings, see, here's the thing. There's a certain higher premium you get because it's earnings season, right? Because you have it, because of the uncertainty of earnings. Selling the July calls, we may not get the same kind of volatility price selling August. But oh, look at that. The August 35 is only 143. That's a ripoff. Holy crap. Is that true? Oh, I see. That was only 34. The August 34s are $2. That's not, see, that's not enough extra money to make it worth it. So I was going to say, sometimes you want to sell an extra month because you get so much more money for the extra month that you may as well sell it, you know, while you're getting the premium. But in this particular case, we're not. We're only getting 70 cents more for selling a month more when we're getting $1.20, $1.30 for the first month. We know for a fact, all right, so when, you know, if I sell these July calls for $34 at $34, and I sell them for $1.30, let's say, that's $35.30. They're at $34.35. So 95 cents of what I'm selling here is premium. And that premium will, for an absolute fact, burn off in the next 24 days. So in 24 days, no matter which way this goes, I know for a fact I'm collecting 95 cents. That premium will expire. I may end up paying the caller. I may pay him back $2. I may pay him back 2 cents. But either way, I still come out 95 cents ahead because he gets 95 cents less than his actual move was worth. That is a fact, and that's what being the house is all about. You're selling that premium because for a fact I'm going to collect it. And that's the thing. It's not an obvious transaction because you feel like we just paid out $3.25. All right? Get back to that. Back to the portfolio. So on May 15th, we sold the 3025 calls for 275, well, 275, let's call it. So now let's see, we'll go back to the Yahoo thing, and on May 15th, oh, that's not fast. What? They're so annoying. They give you the pre-split price. So on May 15th, this is going to be a pain in the ass. On May 15th, when we did it, FAST was at 130.12. So it's 130.12 divided by 4. So FAST was at 32.53 when we did it. And what do? We sold the 30.50 calls for $275. So we collected 30.50 plus 2.75 is 33.25 on a day when FAST was at May 15th, sorry, I just calculated. On a day when FAST was at 33.25. What? Oh, no. Oh my God, that's funny. 33.25 when it was at 130 divided by 4. 130 divided by 4. When it was at 32.50. All right, so we collected, again, $1 in premium. Now, it went against us, and we lost a little bit of money this month. But going against us isn't the point. The point is that what we're doing on the whole is providing a protection for our long-term position, which is gaining in value constantly. So we're providing protection. Look at this one. This one's up $6,000. No, not 6. He's up $5,000 on this side. This one's about break even. So let's say he's down $1,000. He's up 5. So on the whole, the position's up $4,000, and we're protecting it with this. So it's not costing us anything. It doesn't. The fact that we lost 50 cents here. This is 325 that we're paying off. The fact that we lost 50 cents is only 50 times 48 is $2,000. It's out of the money we're gaining. Protection, and we're adding protection. That way, we keep pushing the value. So it's good to keep selling in the money calls and keep doing it. We want to, you want to try to position it correctly, but you still want to make those conservative sales that are going to give you $1. And if you sell $1 worth of premium every month, and you do that for 12 months in a row, that's $12 worth of premiums you're selling. That gives you a lot of leeway for FAST to go up and down on you. All right, so that's why we do these trades that way. It doesn't, sometimes you're going to win, and this is the whole thing. In fact, we were just talking about this because we were writing a book, and we did in the advanced chapter, we're talking about being the house. And the thing you have to start learning is that sometimes you're going to win. When you run a casino, you don't beat every single player every time. That's not the point. But the point is, statistically, if you keep playing and you keep selling these premiums over and over again and people keep gambling against you, over time the statistics are in your favor. It adds up. And that's why we keep accumulating more and more and more cash into this portfolio. Right now we have $225 in cash, right? On where did we just look at that portfolio review? I knew we had it. Well, I'll find it again, don't worry. $13th, which isn't that long ago, it's only 10 days ago. $9,000 in cash. So even though the balance, we lost on the balance, we dropped $16,000 of cash into the portfolio because we keep selling premium. All right? And if we keep selling premium, all we have to do on our positions as we keep dropping more and more and more cash into our portfolio, all we have to do on our positions is break even. And we get to keep the cash. So what's the market value here? See, the market value is $21,000, but we have $209 in cash. Today, the market value is negative $2,000. So we lost So we lost $23,000 there in market value, but we added $16,000 in cash. I don't mind that. I don't mind as long as I'm adding more and more cash in the position, because we can fix this. We can fix these balances. We can figure out how to win in each one of these positions by rolling this or changing that or moving this or strategically adding and subtracting different things. We can figure out how to come out even on these trades over time. You know, like I said, in FAST, for example, we're going to sell $12,000 worth of additional calls for each 10 contracts we have. We're going to sell $12,000 worth of call premium. That's going to get added to our cash pile too. So all we have to do is not lose too much money on the positions, and we keep the cash. And that's what this game is all about. All right, you're not in the stock market to make a pretty spreadsheet. You're in the stock market to get more money. And this is how you get more money, by actually converting it to cash. We had more cash than this portfolio is worth. We have $225,000 in cash. The whole portfolio is only worth $223,000. All right, that's how we run it. All right, let's see what's that fever. Anybody got any questions while we're doing this? All right. Surrender says, are you going to talk about gold and silver? Yes, I love gold and silver. Gold and silver are fantastic. Look, they're long-term plays. I don't know, where are we today? This down here, 1575 or below, is where I start to get excited about buying silver again. Same for gold, though. Gold down here is under 1180. I get very interested because I have tremendous conviction on gold, and at 1550, I have tremendous conviction on silver. All right, but gold and silver are very dollar dependent. All right, and the euro, we're in a no-win situation right now because the euro. Let me see what it is right now. The euro is at 111 now. Goldman Sachs just said that the euro is going to parity against the dollar. All right, that the parity against the dollar means one euro per dollar instead of 1.11 euros as it is this morning. That's a 10% reduction in the euro. The euro is not going to go down 10% without the dollar going up 10%. That's going to be 105-ish on the dollar. Certainly over 100. That's 5%, maybe 10% move in the dollar. That's going to cause a 5-10% move down in gold and silver. All right, I don't know if Goldman Sachs is 100% correct, but there's a ring of truth to it. And as I said, Europe's in a no-win situation. Greece, if this bailout works, here's 1290 on the rest of the week. It's a short again. If the bailout works, then the only reason it's working is because they're diluting the value of the euro by the amount they're going to continue to bail out Greece. So they're diluting the euro anyway. If the bailout falls apart and Greece is unfixed in the next week or two, then the euro collapses of its own accord. All right. So either way, the euro is going down further and the dollar is going up more, which means I'm not terribly excited about playing gold or silver at the moment. Another 2.5% down from here, I'll start getting excited. That would be another 2.5% up in the dollar. So if the dollar's like at 97.50, 98, then I would assume that 100 is going to be a point of resistance for the dollar, and that hopefully 15 will hold on gold. I'm sorry, 15 will hold on silver, and oh God, what would that be on gold? I need a calculator. Hang on. So let's take 1177 times 0.975, 1150. So good. I can use it off the top of my head, and I have to check on the calculator. So 1150. So at 1150, I get very, very excited about gold. 1550, I'm super excited about silver, and I mean excited as in I'll buy it, and if it goes down another 100, I'll buy more, and if it goes down another 100 on gold, I mean if it goes down another 50 cents on silver to 15, I'll buy more. 13 on silver, I'll say people are idiots, I'm buying more silver, and if it goes down to 1,000 on gold, I'll say people are idiots, and I'll buy more gold. All right, but then I'm going to sit there for a long time staring at paper losses of thousands and thousands of dollars on my futures, but I'll stick with it because I believe that that's too low. All right? If your question is, will gold pop right now? I've got no freaking idea. I don't know if it's going to go down. I do know, though, that over the very long run, I start getting interested when it falls below what I think is the fundamental cost of extraction. And gold's fundamental cost of extraction is roughly $1,100. So when it gets down to $1,150, which is just about the cost that people can afford to pull it out of the ground, I got to figure that mines are going to shut happen, supply will crimp up, so on and so forth. That's when it starts getting interesting to me. Now, speaking of interesting, do we have the Russell chart up? Oh, let's see, active trader. Yes, we do. So here's how you scale in. We go like this. There's not much art to it. I go click here, sell one. It immediately filled. And I always go for the gap. I don't, if you go here, if I say sell here, I'm one of 12 people trying to sell. These are 17 guys that are ahead of me in the queue. All right? You don't know you're going to fill that. And the way I trade, again, when I'm scaling in, I don't really care that much about making the extra penny. All right? Not for the future. It's not worth it. I'd rather get my fill. And you see what happened here? I already made, well, you can't tell. I made, oh, here it is, $10. I made 10. So I'm happy just to be over 1290 as an entry. And I feel like that's too much for it to go right now. Now, it did go to 1291.5. And it went there here, and it went there here, and it tried to go there here, but it didn't make it. So 1291.2 though. So I'm very happy when I click this button at 1290.1. Again, you have to understand, you have to realize my tolerance for risk is pretty high. All right? So I'm going to be thrilled if it goes against me for $200 and comes up to 1292. I would double down, and then I'd have two at 1291. They'd be down $200 for 1291. So I don't sweat that entry when I'm doing it. Plus, I'm teaching, and I don't have time to wait 15 minutes for it to fill. There's another reason. Sometimes I'm really, really greedy, but other times it's I don't worry about it. If I'm determined to scale into something, which I will for the purposes of this lesson, I'm not worried. So my plan here with a 1290.1 entry is to double down at 1292, and I will average 1291, which is right about where this thing topped out. So we'll see if that happens, and if it does, so right now I don't care if it goes higher or lower. I already know my plan. I'm not going to stop out at 1289.5. I'm not going to stop out with a $50 win. I want at least $100. So I want at least 1289.1. And if it moves against me, I'm fully prepared to double down. So I know what I'm going to do in every situation. So I don't need to stare at it right now. It's not important. All right? I do hope gasoline comes down quite a bit further. The dollar's moving up. That's bad for the index. So now I want to watch the dollar. I want to watch that. I want to watch the S&P. I need the S&P to fail this line of support, which is right about 2114. And if I was going to watch something else, it sure as heck wouldn't be the... so I got to switch my attention to, let's see. Let's look at the NASDAQ. Because the Dow's not good. The NASDAQ is going to give you a better indication of what the Russell's going to do than the Dow, because the Dow's just 30 stocks that have nothing to do with small caps. The S&P is not even a good indicator, but at least it tells me which way the broader market is headed. All right, so I'm looking for I'm looking for both of these guys to fail their midpoint lines. And again, why do I like the Russell short? Because he's above his midpoint. These guys are at their midpoint. He's above. Therefore, he went too far. It's pretty simple. Too far. Maybe these guys are lagging. If I was bullish, I would say these guys are lagging, and I'd grab the one that's lagging, which would be the S&P 4 bullish play. But I don't feel that. I think they went too far, and I think it's going to pull back. And again, it goes to a lot of factors. We have another day of fairly low volume. You can see right here. Well, I don't know how well you can see. But you can see here that today's volume pattern is not very different than yesterday's volume pattern. So, and the action pattern is not very different either, except that it's more compressed. Okay, so you got the same kind of action, same little pattern here. Big up at the open, then down, then a little zigzag. So I expect to see just like we did yesterday. What did the Russell do yesterday into the close? It made a nice dip over to this line. Well, not this line, but to the next support line. So I'm hoping the Russell comes back to the support line. That'll be a nice little win. All right, and if you do these future plays right, you're actually pissed off that you didn't have more contracts. You know, I mean, the way when you're scaling in, a lot of times you make very small wins with one contract, because that's fine though. You know, so you take a little bit of money and you go home. But you get to do it over and over and over again. It's only when you make a mistake and only when it goes against you and your entry wasn't good. That's the only time you're going to scale it, after you check to make sure that your premise is still sound. All right, so we covered silver and gold. Savvy says, Chrissy says, what are my thoughts on ES? I don't think 2120 is sustainable. 2120, I think, is the top. No matter what, you know, fixing grease doesn't make the S&P earn more money. Okay? It's, in fact, fixing grease means you have less global instability, which means the Fed has less reason to maintain a loose policy, which means they're more likely to tighten, which is bad for the S&P companies. So there's nothing about fixing grease. The situation in the U.S. market's better. And our take on the U.S. market, as we've gone on and on for ages now, I've been talking about it, is that we're just overly exuberant, that the PE ratios, the projections on earnings are too high, they're unrealistic, that everything is based on an ultra-low interest rate that's not sustainable. So therefore, I think 2120 is toppy on the S&P. And I'd like to see a nice 10% pullback. Then we can consolidate. Then a little bit of time passes. Then we get an earnings period. And then you can talk about at the end of the year 150. But you've got to consolidate first and pull back. All right, so Craig says, I'm late. Did you discuss? That's so funny. Yes, we did. We talked about scaling in. I do think it's going to go back. 2750, though, is where I exit. Like, I doubled down at 20,900. I'm exiting at 20,750. I'm not staying in. Now, my entry is lower than yours, though, so that's my break even. What I would do with at 2750, I would certainly lighten up when it gets back there, because obviously we were, you know, 20,600 was what I wanted to start at. That didn't work out. And the dollar's very strong. We don't see any reason it's not going to stay strong. So that's going to make the yen happy, or unhappy. It's going to make the yen weak, which makes the manufacturers happy. So I believe that I wouldn't double down on that unless you're at 20,250. Now, of course, if the yen is at not 20,250, 21,250. And if the Nikkei is at 21,250, though, then we got kind of a problem, because that's like over 1,000 line, which we really didn't think was going to get broken. So, in that position, I would just hang tight, and I would hope that it gets back to 20,750. And frankly, if it doesn't break below that line, I just get out and say, you know, okay, the Nikkei is just not working. I'm personally going to be probably all out, or at least mostly out, by the time I get to 20,750, because 20,006 didn't fail. And we thought it would fail. And since it didn't fail, maybe it's support. And if that's support, then why do I want to be shorting up here? All right, Chrissy apparently says her sound goes in and out. TF short, yes, was answered by me just going there. And Surrender says, took Nikkei short. Well, I hope it goes down too. All right. Now, let's see. What else is going on? Oh, portfolios. We're in the middle of doing this. We didn't even get anywhere. Jeez, you guys got to keep me on track. All right, anyway. So we have our big SDS trade, of course, but that's September now. We have no pressure here. All right. What we have to consider, though, is if we don't think the S&P is going to go down any further, I do, so I'm not looking to do this, but if we think the S&P is going to go down further, then we want to look at the SDS. This goes back to being the house. How can I make money off my investment position? My investment position is 100 SDS September 19th. Okay? And by the way, the quote you get, which is typical, of course, there's nothing weird about this, but the quote we get here is 125. The bid ask on that position is 125, 148, and the last was 138. So we're getting ripped off for 13 cents times 10,000 positions, which is 10,000 options, which is $1,300. All right, so or is that 13,000? Wait, that can't be right. No, 13 cents. It's $1,300. So we're getting ripped off by $1,300 on our balance. It's another thing you have to realize when you have open contracts like that, is they can really hit you for a negative number here that's not really representative of what you're actually trading. But anyway, so there's nothing dire about this position at all. What we want to see, though, is we're at 1990. So frankly, if I want to say, what is this position worth to me? This position is worth 90 cents to me. Because we have the 19 calls, and they don't give a crap about the time value. Time value is what we sell to other idiots who think they're going to make money. So when I'm looking at the value of my positions, I don't count the time value because it doesn't mean anything to me. I care about my position value. So this position for me is worth 90 cents. So what I want to say is, what can I do with this thing to make some money or to offset my cost? And I can say, well, I could sell the 20s, but the 20s aren't much fun to sell because I only bet $1 spread. That's no fun. I could sell these 21s, though, then I have a $2 spread, but it just doesn't seem worth it, right? It's not enough money. So selling any of these calls, I'm not. If I was really worried, I would sell maybe half of the 20s. I'd rather sell half of the 20s than all the 21s because all it would do is cover half of my longs at $1 gain. It would generate for me, though, 500 times 42 is like $2,000. It would generate for me $2,000 in cash, and I still have 50 completely uncovered September 19th. So it would keep going up no matter how high no matter how low the S&P fell. It would keep going up. So if I was going to short something, I would sell 50 of the July $20 calls. So I'd be partially covered, 50% covered on my long position. I don't want to do that, though, because I frankly, I just don't think 21.20 is sustainable. But this is similar to the trade we did last month. In fact, it was exactly at 42 cents that we did cover last month. So it's the same exact price it is now, and we did very well on that trade. All right, but I'm not looking to do that right now. I'm just looking to maintain where we are. Another way to look at it, though, is I could sell these for 42 cents and then take that 42 cents because I say, look, this is a hedge. I invested in the hedge. And I take the 42 cents and roll the position to a lower strike. So $1 of in-the-money premium with the money I sell those for. All right, or I might buy some time. I might go out longer position here. You see how these 19s are, January 19s are about $2, $2.10. So if I wanted to spend 70, 80 cents, I could roll out 3 more months. Now, 70, 80 cents, 3 months, but I can sell 1 month for 40 cents. So it doesn't really cost me anything. I'm just buying more time that allows me to sell more calls down the road. All right, but again, it depends on how badly you need the hedge. We don't need this hedge very badly. We're in very good positions in the long-term portfolio, so this is still a bet. And at this part of the month, with only 4 days left to go in July, and I'm really not in any kind of panic mode about selling. But before this weekend, I'm going to want to collect some money off those FTSs. All right, so by Friday, we'll be making a decision on that. We are short Japans. They were in good shape, and now they're down, so hopefully they'll come back. Here's a long-term play on silver. Here's Tesla. That's actually a long on Tesla. I don't like Tesla, but I like them. I like them at $140. I don't like them at $264. So we're just betting they don't fall below 140 by January. XLU is left over from an old trade. We were bullish on. That's so-so. I'd say it's on. No, it's not on track, actually. It's not working out so good. It's even. The trade's about even. Cape hold boat, which is great. SQQ is a longer protection. All right, but we got to start thinking about this one too. Do I want to adjust it? Because we paid net 340 for this spread, 345. Now the calls are at $4. So before these calls fall below what I paid for the spread, I have to lock in my value on SQQ. Now it's worth, how much is it worth? It ain't worth $4. It's worth 220. It's worth 270. The $20 calls, the stock's at 22.70. It's worth 270. So I should feel lucky to get $4 out of it, right? That's somebody's an 80 to pay me $1.30 in premium. All right. So while it is premium, I want to collect it. It works the same way when you're selling something you own as anything else. When you want to figure out a way to collect that premium, how can I use that? These $30 calls are toast, right? Even though they're still priced at $245, they're probably dead. So we got that money coming to us. So what we want to do is make an investment. And let's take a look, January 20th, all right? So SQQ January 20th. SQQ. And we're going to go to January. And here's so they're about 431 is the last sale. So that's probably, maybe you can get 450 if you do a good job. We certainly aren't going to roll them down. That doesn't do us any good. We want to be in the 15s. And those 15s look pretty, well, the spread on the 15s is ugly. If I'm going to do anything, I'd want to move out to next year. I'd rather go to June. I'm not a year out because there's a big premium to pay. But asking prices, you really want to go by the last sale. So here's, I wouldn't see. And here, look at that, $9.55 for the 15. See, those 15, that's a lot of money. I'd rather get these for $6.80 if that's feasible. Now, if I can spend $2.80 or $2.50 a year of protection for my portfolio, I don't mind doing that. And also, what do we know? If we sell here's a year at $2.80, how much is a year worth to me? Well, a year is worth certainly what I can sell short-term SQQs for. So that's SQQ by $2.50. So if I spend $2.50 to buy another year, what can I sell the August 25 for? And holy crap, I can sell them for 85, 90 cents. All right, they're right there. I can sell them for 85 or 90 cents. Look how fast I'm going to get back my investment, 50, to roll a year. I'll get that money in sales. I won't, though, because I'd only have cover to get my money back. But still, conceptually, it's worth it, right? It's worth it for protection, because during that year, I'm going to be able to recoup the money I'm spending to buy the protection. So really, when you do a lot of these hedges, if you maintain them properly, that's interesting, like maintaining your hedges, then you like staying with those big garden shears, like keeping them in shape. But if you maintain your hedges, you take care of them, you roll them at the right time, you make the correct adjustments, and the maintenance cost of your hedges is much, much lower than the initial cost of the hedges. And that's why, again, these portfolios, they start snowballing and making more and more money as time goes on. We have money to protect. We have deep in the money positions. We don't need to protect as much. We have much less chance of our puts getting put to us, and even if they do, we don't care because we have tons of cash on the side. And our protection investment is we just keep rolling it along, and buying a year is a lot cheaper than when we buy the initial protection. So there's a lot of factors that drive our portfolio to higher numbers as they go forward. This is all about, that's just a game we play. That's not a hedge. FAS is only a game that we play where we sell the ridiculous front month premiums that FAS has. So we expect oil to really take a pop sometime in July 4th. That's not happening. This is the leftover piece of a play. Oh, I'm sorry. In this particular SEO scenario, we're not doing that because what we did is we already took the money off our long calls, and what we're betting here is up, but it won't go up past 60 or past 60, which is probably at $65 oil. So I'm sorry, this is the leftover piece of a trade. We expect these to expire worthless and pay us off this money. We don't expect it to go lower than 60, basically. So we think oil is going to finish off pretty close to where it is now into the holiday, but a bit higher. Here's that fast. Here's FSP, which is we're still short on China here, taking big loss now. So we might want to add or change this position at some point. Here's one of the liquidators still doing us no favors. Here's Netflix, where we got screwed because they, we got screwed because they moved their earnings expiration. That's how we got screwed. Originally, their earnings date was after. As they moved their earnings date, the premium on these things shot up tremendously. And so now it's just basically this is a risky earnings play, and we'll have to think into earnings, which is about even, a little bit better than even. And then there's TZA, another protection that we have. And in this case, January 7 long calls are in the money by $2. We spent $230, $220. We spent $220 on the spread, and they are $2. So these also, same as the STQs, we're going to have to think about rolling those as well. All right? Let me look at the, before I get out, let's why did you move to September on SDS? Because it's what I mean about maintaining your hedges. I always want to hedge. As long as we have positions in the long-term portfolio to protect, as long as we have longs we're protecting in our long-term portfolio, we want protection in the short-term portfolio. So we're maintaining what's on SDS. So I want them this month, and when it's like insurance. It's like saying, well, why did you pay for another year of life insurance? Well, because I lived this year, but maybe I won't live next year. That's the way you're looking at this thing. It's like I don't know when the market will crash or if it will crash, but I'm trying to spend as little as I possibly can on insurance. And rolling them, especially when you're rolling and selling some short calls, is the cheapest way to do it. But you have to be careful about how much you sell short calls because you're also then giving up some of your protection. But because we have QQQ, and we have the TZAs, we have them in layers, each long, we can pick up a little bit on one and a little bit on another without compromising our overall protection strategies. LL is at 7% today. Oh, very nice. That's a good one. I tell everyone to buy that. That's like the one I shout about lately. Craig says, if you're looking for a pop in oil, what's the inventory tomorrow? Inventories tomorrow will just be what they'll be. There's nothing going to happen much tomorrow. And it doesn't matter what happens tomorrow. If it's disappointing, it doesn't matter. If it's disappointing, we're going to start down sharply, we're buying. If it goes up sharply, in fact, we'll be pissed off if the gasoline doesn't give us another entry. Probably going to be a middle-of-the-road sort of number tomorrow, but it doesn't matter what happens tomorrow because what matters is July 4th is coming. Right. And they're going to imagine, no matter what number comes tomorrow, they're going to imagine this. They have dreams of fantastic demand coming up for the next 2 weeks. To July 4th, if they have disappointment, it's into July 4th, that Wednesday, July 1st or July 2nd, July 1st, I guess. So on July 1st, it'll matter because on July 1st, they're going to say, they're going to expect a good draw on July 1st because, first of all, the refiners should be pulling a lot of gasoline, a lot of oil cans off the market. Refining a lot of gasoline too. We're driving on July 4th weekend. The airlines that are flying, the cars that are driving. So they're going to, in anticipation of demand, they're going to start producing a lot more gas. They certainly expect a good, necessarily this week, but next week for sure should be a very nice draw on oil. The week after that, then we would expect a very good draw on gasoline because the usage of it over the July 4th holiday weekend should be apparent by then. That's cool. We had disappointment Memorial Day or whatever day it was that went by, Labor Day. We had disappointment, and we may have disappointment again. but we'll see. All right, but I'm not playing for that. I'm playing for the hope that it's going to pop to the holiday. After the holiday, I'm pretty much going to be looking for shorts because I don't think the demand picture that they're envisioning is going to show up. Christy says you often sell a call and then buy at a lower strike. I thought you'd buy at the highest strike to limit your loss. What's typical? I couldn't even tell you. You sell a call, lower strike. I thought you buy at the higher price. You gotta be more specific to figure out what that means. Sorry, Christy. All right, so moving on to the long-term portfolio. 47%. All right, but like I said, these things go up and down. You can't sit there and wait balances. 47% is pretty good. We got look at that. It's like 750K, 733 in value. And last time we did this was let's see what the long-term. Which is what we want, though. We don't. Very, so we would make a ton of money on that side if it goes down. So our bet is generally that the market will go down, and I think we calculated we were losing about $5,000 per 1% the market rises is where we were, and we're fine with that. That's our bet. We're that much bearish. We're $5,000 bearish on the market at the moment. But this is a live one though. Here we got, these are all the short puts, and these are just basically bets saying, look, if it gets down to this price, if AA is 13, well, it is 13, it's below 13, but we made an aggressive bet here. But if AA is 13 minus 245, which is 10, we'll buy it. If Sotheby's is $37 minus 290, so 33 bucks, we'll buy it. It's 46, we're not going to buy it, we're just going to end up keeping the cash. If Broadcom is 40 minus 4 is 36, we'll buy it. That's never going to happen. We'll keep the cash. And how much is the cash, though? We're going to keep 3,700. We're going to keep 1,400. We're going to keep 4,900. Those are our consolation prizes. We're never going to own these stocks if the market goes up, but we're going to own this cash. And these unrealized gains are tremendous on these things. So CMI, Coach, Hog, that's how we do all these things. That's how we establish a position by saying, look, I'm not sure I want to own these prices. These are all stocks that we weren't sure we were getting a good entry on, so we didn't get too aggressive. The way to do it is to say with Twitter, you know what, Twitter seems cheap, but I'll sell the $33 put for $470. Holy crap, who did that? Not only that, but you can still sell it for $555. That's crazy. I endorse this trade. So if you do this trade now, you sell 10 Twitter 33 puts for $550 or $555. That's $32.50 and minus another $5, $27.50. Your net entry on Twitter is $27.50. You don't lose a penny until Twitter's at $27.50. Then you have to buy it. I have another. Would be the way I would look at that one. That's great. Who else looks good? UNG I like. That's a long play on natural gas. iRobot is still where we went into it. That's a good play. Hovnadian, I always like Hovnadian. You're netting in at 250 on Hov. It is 250. It's not like better than buying the stock, but I think that's going to be a good one. Harley Davidson, that's not as good as we entered. That's not as good as we entered. CMI is as good as we entered it. That's a good trade also. Nice cheap entry. Broadcom, nope, that's gone. That one's completely gone already. Nope, that's my favorite. Okay. So definitely Twitter is my favorite. UNG would be my second favorite here. All right. Who else do we have? We have, now here, we only took the, because we didn't want to commit to buying the stock if it went lower. So on RIG, or maybe we took the profits already. I think on RIG we actually cashed out, so we had June short puts. And so now we really have to sell some more puts on RIG. But on RIG, we have a bull call spread. Seadrill, we have a bull call spread. Oh, and there's logic to Seadrill, because Seadrill, if it gets lower, we don't want it. If it tastes at $11 now, we don't want to own it if it gets cheaper. This one was a nice gamble, though. I like this trade. We have Armor, if it REIT, pays a nice dividend. Canadian Mechatronics pays a nice dividend. So those are stocks we own. We also own Chimera here, who pays a dividend. The only reason we own the stock is if they pay us a dividend. If they don't pay us a dividend, why should we own the stock? There's no difference. So we have ADX, we have Arrow for Clothing, Huawei here, DHI, CCJ. Here's that. This is the China Ultra Short. We've got Cleveland Cliffs, which, why is that one here? Oh, because it's very aggressive. This is a long call and a short put offsetting the long call. This is a really big bet that Cliffs is going to go up, which frankly is not necessarily going to happen because China is just terrible right now. The manufacturing numbers out of China are awful. DBA, I like. It's a great inflation hedge. And Connor's Gas, I like them. Joe with Coffee, that's not doing too good, but I still think coffee is going to come back at some point. Here's one of the liquidators. We have a nice play on them. Why do we have so few, though? I wish I had more. How about that? Here's Lulu. They're back to being a generally bullish play. They're about even. We have Mattel, also an aggressively long play, which is working out so far. Manitoba, and that's about that. Mylan expecting so they were a takeover rumor, and nothing's really going on, so they're kind of floating around. Have to reconsider whether they're worth holding at this point. We have OIH, well, we have all faith in them, so we like that one. We have Transocean again over here. We have Silver Wheaton, we like silver, and that's an aggressively long play. We have Taser, we love Taser, so that's not even the question. Here's Time Warner also playing the merger game, and we'll see what happens with them. And UCO. And UCO, oh wow, UCO is banging. Wow, these will expire. The same thing. It's the same as the other one, though, is that we have a range here, and we already dismantled this trade and took the profitable calls. So we have the long July calls at 25, and we're going to be fine on those. And we have these short 50s. So we just kind of expect UCO to stay under 50, and we'll collect the full boat, which is quite a lot of money. We'll collect about $25 here, and these will zero out. That's very nice. So we still have another few $1,000s to make on this trade, just as it is now. So almost I could say this is a good trade to start. If you do it right now and took this trade, it's probably a good trade to make a few $1,000. But we already made like $6,000, $7,000. So it feels kind of weird to recommend something that we already made most of the money on. $1,000 portfolio. Nothing exciting there, although back around almost getting 20%, but still need some work. We're waiting on lumber liquidators to do something nice for us, basically. We got the August 28th. That's going to be hard. I don't know if that's going to happen. USO, we had the calls July, and we're really going to have to just take the money back when it's even and take it because I don't think we can go that much higher. We got the Japan short. We should have taken that money and ran when it was offered to us, and we have a DBA spread. All good positions. I like all those. And butterfly catching is our last one. And 53.8 is pretty good. Where were we last time? It's only 10 days, but I still like to compare. Nope. And there you go. That's nice. So we picked up a few percent. Where are we? Butterfly. Well, 53.6, so that's 53.8. All right. And again, with the butterfly portfolio, it's the same thing. Look, it's almost all cash. We're using very, very little of our buying power. And in this particular case, we're not even, we are using margin. I don't know what we did that we're using margin. Let's figure that out. I think it's these. I think it's these short Disney calls. Suddenly we're using up a bunch of margin. We got burned on Disney. We rolled to these calls, and we'll see what happens. Otherwise, BTU. BTU's turned into a bet, and realistically, it doesn't belong here. I mean, BTU is just we're kind of betting it'll come back one day. I don't even think it will. We're just stuck with a bet that we thought would work, and it won't. And at 250, they're not even worth selling short calls against or anything like that. So I would have to say, I think on the whole, I'm going to want to kill this one and make room for something else in this portfolio. Because it's an unprofitable position. It's not. I can make a lot more money working with something else. So why should I keep that in there? Here's the rest of Disney. Here's J.P. Morgan, OIH. We'll see what happens with earnings. But yeah, we're going to get rid of BTU because that's just wasting space in this portfolio. And this portfolio, though, if you're a new person, I got to tell you, I love this portfolio because we don't ever touch it. Once a month, what we do is we sell puts and calls. See what we have here. See these July calls and puts, short. Here we have short July puts, short July puts, short July calls. Short July, here's short July puts, short July calls. That's all we do, short July puts, short July calls. So every month at options expiration time, we'll sell the next set of puts and calls. We collect our premiums, and then we wait for it to expire. And then when it expires, we sell some more. And sometimes we win, and sometimes we lose, but we don't care because we always collect our premium. This is the lowest risk portfolio that we have, and it makes just as much money as the long-term portfolio does. It definitely has less risk than the long-term portfolio. We have except for this, it's a little bit unusual that we have this naked Disney that's using up margin. Usually we're using no margin on this portfolio either. And there's no need. It's the naked Disney calls. If we close these, they were $1.80 and $1.90, and we're not closing. We're just letting them ride, and we're hoping they kind of evaporate a little bit. If we took the loss, then we wouldn't be using any margin. We have the margin available, so we're using it, and we're hoping we do better. But if we just played this more conservatively, which is obviously the easy option, we just stick with these guys, and eventually we'll make our money back. Look how far ahead these guys are. 12,000 here, and 3,000 here is 15. Minus 7 is back to 8. Minus 4. So these are plus 4,000 on this set right now. All right, so we don't need to make this money back. I have money back. It's minus 3,000. But we don't need to make it back because if we keep the Disney position that we have now, every month it's going to generate, how much money do we sell this month? July. We only sold these in July. But every month we're able to sell another few $100 worth of calls. Another few $1,000 worth of calls. So we're selling 1,000 every month. And if we make some of that money back, it's going to be another 5,000 by the end of the year. So, we're just being a little bit greedy. We're just sort of going for a better payoff. But so far, we're certainly not getting it, unfortunately. And the reason is because Disney totally shot up on it. It went up really hard and fast. And where is it? And so far, it hasn't pulled back yet. See? I don't know, adding insult to injury, it continues to climb. It never stops. We wanted to go, we could have taken some money off here, but that wasn't enough. So we really would like it to go down to about 105. At 105 will be $5,000 more at 105. I would be so thrilled. I'm hoping that happens before it goes to over 115 and we're kind of forced to pull the plug. All right, but other than Disney, which burned us, this is and BTU burned us the other way by being valueless. But look at the loss; it's only about $2,500 loss. In general, though, this is such a reliable money-producing portfolio. It's just wonderful to play. It makes really, really good money, and it has very, very low stress. So if you want to learn options, it's a great way to learn options too, because you make a lot of plays, but you're not taking a lot of risk. You learn the ins and outs, and you see a lot of action. But since you're kind of betting all over the place you're not betting. I'm sorry, you're taking bets, which is exactly what being in the house is. You're taking bets from everybody on both sides of the table. So you're taking long positions that are fairly neutral, and then you'll let people place bets on which way the stock goes. But you don't care which way it goes because you're covered. And you're taking everybody's short-term bets against your long-term position. And that's how you make a nice amount of money. It's a great way to generate income, and it's a great way to learn options because you'll see everything. Over the course of a year of doing this, you will see every single possible thing that could happen to option contracts. You'll see a sign-on splits, you'll see reverse splits, you'll see dividend effects, special dividends get paid out. You'll see everything happening in this portfolio. And by the time you get through a year of this, you'll be a pro option trader. And that's probably, other than paper trading, it's probably the least risky way to start getting involved in options. I love this portfolio. It's called our butterfly portfolio. It's a great thing. All right, 2:30 already. Holy cow. All right, let's see. Who's got questions? Last questions, and then we go. Did Chrissy ever clear up her thing? You often sell a call and then buy it low. I still don't know what that means. When do you typically roll or close a call spread? When do you typically roll or close a call spread? I guess when a spread isn't working. There's no when. I mean, it's when you decide that it's no longer valid. You have to always look at your expectations. Like with Disney, do I have expectations that Disney will pull back $10? If I don't, then what am I still in that spread for? I have to get into a spread that's realistically going to target where it's going to be. So the fact isn't working means, at the point it isn't working and I don't believe it can work, I really have to do something else. And if my risks start outweighing my rewards, that's another reason I might want to get out of it. But it always depends situationally on looking at it and seeing what you think your game plan is going forward. If you don't like your game plan going forward, then you've got to get out of it or figure out a different spread or figure out a different plan of attack. All right. As to rolling, though, generally we're going to roll. We want to roll to something that has more premium when premium starts getting chewed up. So in other words, if I collected half premium on a contract already and it only has a little bit more to give me, well, let's say 2/3, and almost certainly by 75%, I'm pretty much done with a position unless I feel there's some other reason to keep it. Like I know for sure I'm going to collect the last 25% after 75% up. But it does depend on a lot of things, and look, when you're in member chat during the daytime, this is what we talk about all day. I mean, but we talk about it by example of hundreds and hundreds and hundreds of positions we discuss over the course of the year. It's something you got to learn. Okay, so almost, the question is almost like saying, when do you put in a pinch hitter? And it's like, oh, here's the answer. It's not really an answer. You have to be situationally dependent. So it is, and those are the broad outlines for how it works. Let's see. Anyone else having issues? How to share your screen keeps popping up in full screen mode. That's me. No, Pat, when I'm looking at the chat box, this is me. This is my how to share your screen, see? It's not yours, it's me. I think that's what your problem is. In this particular chat thing, when I go to Q&A, I have to look at this window, which has this stuff on it. And that's got that little box on it, but it's not a message to you. All right, Jal says, I have BHI, bull call spread with a 55 put, 70 call shows a profit. Would you take the profit? No, because it's going to, they're going to call it away. It's going to, the deal will complete probably in the next 3 or 4 months, and everything will get called away and it'll close. So just be patient. All right, you certainly don't want to leave a naked leg that goes against you, because what if the deal terms change and it adjusts up or something? You don't want to mess around like that. Just leave the position. The assumption is the deal will finalize over $70, and that would make everything expire. You'll collect $12.50 net on your spread, and the put will expire worthless, and you're done. So you'll get $12.50 times whatever amount of positions you have. Lucas says, quick OT question. No, we don't do OT. Well, it is OT already. Just want to hear your thoughts on liquid metal. I love liquid metal. I don't know what they're at now, but I love that stock. I just love them because they have such cool stuff, and one day someone will figure out what to do with it. There will be, I think there will be an Apple product. It's 12. Yeah, this is where I definitely like buying them. Down around here, I like buying them around 17 or 20 is where you want to sell them. And one day they might pop to $1. I think they will one day, but they're very up and down stock, and it's they have a great cool thing. It's cool technology, but it can't really be applied in the real world, because when you start dealing with large amounts of it, it gets all skittish, and the manufacturing process is a real bitch, which is not much different than the other ones, GTAT, with their glass, because the manufacturing, it just didn't. It was a fantastic material, just didn't make it through the manufacturing process. When Apple needs 50 million of something and they can't rely on it, it's not usable for them. And in both cases, Apple, the material technology was so great, Apple got involved in both of them, and both of those companies are basically on hold, waiting for Apple to figure out a process. That's what's dangerous about investing in those kind of companies, because they do it. They're going to take the money from a big guy like Apple, but then they're sort of stuck with them. What is the fastest human in the world? I don't know. Why would I know that? I mean, Google. That's what Google's for. Says the guy with the golden shoes, right? Pat, yes, I've had the same issues with how to share your screen popping up. I'm pretty sure that's the one. Off topic. I thought it meant overtime. And Pat says, not always. While you had the spreadsheet open and we were discussing positions, it would pop up on mine. Oh, what happened? Your cursor around. Oh, I see. When I was moving my cursor around. Okay. And they can't scale. I don't know what that one means. What do you think about using Microsoft to replace BTU in the Butterfly portfolio? That's worth considering. All right, last topic of the day. No more questions will be asked. Microsoft. Well, it's going to come down to how much we can sell them for. Excellent. That might be a good topic, but we'll talk about it. This is exactly what you do want. You want something that's volatile, but volatile in a channel, which means there'll always be good prices for the puts and calls that we sell because it looks volatile. Well, it is volatile. This is $8. All right, that's 20% move. But it still stays around the range, which means if we get burned, we can stick with it, ride it out, and hopefully we'll get our money back at some point. So I think 45 in Microsoft is a very good solution. Then what you want to do is you want to look at Microsoft and say, hey, how much can I sell July 45 puts and calls for? All right, and the July 45 puts and calls are 130 plus, ooh, I don't like that though. See, these puts are a terrible price. 130 plus 40, that's kind of ugly. And how about August? August is 130, oh, well, August is way better though. See, here's the case where going out a month makes a big improvement, probably because of the July expiration. You get paid 131 and 2, and you can even spread it so you can sell the 44 puts, so you have more room to fall. 95 cents here, and the 46s are the 47s are 95 cents. So figuring about almost $2 for selling the August that are out of the money ahead of earnings. And then you have to say, well, how much money would I need to protect that? Because I know that I can sell the August for $2. And let's say we bought the 40 puts for $3 and sold the 50 and bought the 50 calls for $3. And now we're spending $6, but we're getting we're spending $6 for the longs, but we're getting $2 back in the first 45 days. So that's a great butterfly position. It's a very good suggestion. I think we will do that. All right. In fact, I would say almost definitely officially. Almost definitely officially. So keep track of the member chat room. We'll figure it out, all right? Okay, thanks, everybody, for coming. That was a very excellent selection, G-Base. Thank you very much. We will be adding that to the portfolio. So in other words, so just to make it official, let's say we're going to do this. We're going to buy 10 of the 2017 40 puts for $310. We're going to buy 10 of the 2017 50 calls for $3 or $305 or whatever it works out to. All right, so that's spending that. And then we're going to sell the August 44 puts for 92 cents. And we're going to sell the August 47 calls for $1.30. So think of the power of that thing, all right? So Microsoft's at 45. We've given ourselves more than $1 of room on each side, more than $1 of room on the top. So we've given ourselves $1 of room on each side, which is 5% up or down, and we've already collected one-third. We've already collected one-third of what we laid out. So if you think about long term, what if we sell as it's 45 days? So what if we make like 8-10 sales like that? We're going to collect. If we make 10 sales like that, we're going to collect $20. against a $6 outlay in the long. So all we have to do is hope Microsoft stays more or less in the channel, and we're going to do fantastically well. That's exactly the kind of position you want to do in these things. All right, guys, that's a fantastic way to end it. We have a brand new butterfly trade. We haven't had one of those in a while. Thanks, Keybase, and thanks, everybody, for coming. Appreciate it.